Hello and welcome to episode 17 of the Bitlemmas podcast. I'm Watson. I'm here with B Sovereign. And today is a book review of the Bitcoin Standard by Saifedean Ammous. The point is not to repeat Bitcoin slogans, the point is to understand the monetary argument. What makes something money? What makes money hard? And what changes when issuance and settlement move from institutional discretion into rules users can verify? Standard Story says money is mostly government decree. Bitcoin is mostly a volatile tech asset, and blockchain is the real innovation. This book argues the opposite order. Money begins as a market standard selected for saleability. Hard money resists supply inflation, and sound money changes saving, calculation, and time preference. Bitcoin matters because it tries to implement digital cash with fixed issuance and no trusted monetary issuer. We'll be reviewing four counterintuitive truths. Money is selected, not just decreed. Hardness is supply. Inelasticity, sound money, changes time preference, and Bitcoin's inefficiency is the point. So, what's this book? It's a monetary history from barter to Bitcoin, a theory of saleability. We'll talk about what that is. Hardness. We'll also talk about what that is. And monetary standards. It's also a critique of fiat money. We'll talk about what that means. Central banking and credit expansion. It's also a claim that Bitcoin is digital hard money, not generic blockchain technology. So, what's the standard story? Or what the author believes the standard story is? Money is whatever government declares legal tender. Inflation is just a policy tool for managing demand. Bitcoin is mainly a volatile tech asset, and blockchain is the innovation. Bitcoin is just one app that has a blockchain. Now, what's the thesis of the book? Money is a market standard selected for saleability. We'll dive more into that. Hard money preserves value because new supply cannot surge. We'll dig into that as well. Sound money lowers time preference and improves calculation. And Bitcoin is digital cash, fixed issuance, peer to peer settlement with no issuer.
Yeah. So this book is I'm actually really excited for this one. But I wanted to go down really to like what this book actually is. The Bitcoin claim, just in general, it only makes sense after you've learned the true foundations of it, and I think that this book expresses it pretty well. The author, Amos, he's especially hard on the blockchain, not Bitcoin story, because there's a huge difference between how different blockchain technologies work with different proofs. But yeah, this one is going to be an exciting one. We can kick this off.
All right. So, what are some major premises of the book? Money solves barter's scale, time, and location mismatches. We'll delve into what all that means. Saleability across time, space, and scale determines monetary adoption. And we keep talking about saleability, but it is the ease that you can convert or put a good on the market without a discount. It's the ease of that is the author's view. Stock to flow measures how hard supply, how hard the supply for some good is to inflate. So stock, we're going to get into that. Actually, we have some slides for it, so we'll get into it. Network effects push markets toward one or a few standards. What do we mean by network effects? And then what do we mean by markets? Markets for the goods. We'll dive into that, and then standard. Control over issuance is control over the monetary standard. So this is where you can look at things as being a little scammy when it comes to money. But you may not understand how scammy it is. So he digs into that. Now, our four counterintuitive truths that come from the book. Truth number one: money is selected, not just decreed. Truth number two: hardness is supply inelasticity. Truth number three: sound money changes time preference. And number four: Bitcoin's inefficiency is actually the point. So, truth number one: money is selected, not just decreed. Fiat decree alone does not create saleability. What is fiat? Fiat is when you have fiat money, it's when the government says this is the money. It could be by mandate or other means. We have a fiat money, the dollar is fiat. It does not mean that it creates saleability. It doesn't mean just because the government says so, doesn't mean that it's easy for that good, that money, to be converted in the market. Now, people converge on the most useful medium of exchange, under real constraints. What do we mean there? People want to use, it could be the most saleable good, the most liquid. People will, those goods will turn into money, is the author's view, at some point. And there's various properties. But the most useful one is what people will converge on. For instance, historically, gold. Good money wins across time, space, and scale. There's more properties for the money as well. But those are few. And sound money emerges from use, not just legal command. What do we mean by sound? Sound resists debasement. So what's debasement, and what does that mean? It's when it could be the issuer tries to increase the amount of money and it reduces the value of the money. That's one way. The other way is reducing the quality of what backs the money. So that would be an example would be coin shaving. So if you have a fourth of an ounce of gold in a coin, reducing that fourth to an eighth, but saying it's a fourth, and then distributing that would be debasing.
So yeah, I really like the gold shaving, because that's actually a real thing, and it's noted in history that this is something that that monarchs were actually doing to its citizens. But so yeah, to really hunker down on the first truth, money is not a government invention. It's market selection. Ammo starts with a question: what makes one monetary medium win over another? His answer is saleability, the ability to be sold easily. So saleability across scale means it needs to be divisible without loss. You can buy bread or a house with the same unit. Salability across space means it's transportable without loss. You can carry it or send it. Salability across time means it's storable without loss. It holds value across decades. So most goods fail one or more of these tests. Cattle are hard to divide, right? Unless you're, packaging up beef. Seashells, they can break. Grain, that can rot. Gold won because it passed all three of these tests better than any competitor. But even gold has its limits. It's heavy. It's hard to verify. Again, you can getting fool's gold. It can be shaved down, and settlement requires physical delivery or trusted intermediaries. So, the implication here, which we're bringing it back to development, is that every monetary system has saleability properties. The question is whether they're visible. Can users see how divisible, transportable, and storable the medium is, and can they see who can change those properties?
All right. Here's a diagram. So we have barter mismatches on the top. What is this? This is the idea of the coincidence of wants. So this coincidence of wants is where you have two people that want to trade, but they have to have, there's a mismatch there. They have to have, one has to offer something that the other just so happens to need at the same time. So this, when they don't, that's a mismatch. And this creates the problem and creates the vacuum that money tries to fill. So indirect exchange is the next stage. Indirect exchange meaning you use a third good that has some of these other properties we're talking about: durability, saleability, division, dividability, or what have you. So, and portability. So, indirect exchange, you could say some person has shoes, the other person has horses. They may trade in carry shells, seashells. So, that could be, if that is something that people recognize, that could be the more saleable good. So, they trade in that. If there's, then the carry shells can become wider acceptance. You could say gold as well. And then what emerges is this concept of the unit of account, where people start reasoning and accounting in the good. They start measuring everything else in that good. And that would be more of what you could call the standard. So truth number two, hardness is supply inelasticity. Hard money, when you have hard money, the demand rises and supply cannot easily surge. Another, to say it in the other direction, supply hard money or hardness is the resistance to supply expansion when demand rises. Easy money is demand. When demand rises, the producers inflate the supply. Let's give some two examples. So for gold, you could have um, the hardness of gold makes it, because it's harder to mine. We're going to say in relation to relative to silver, more people can want the gold, but it resists. Even though you can mine and you can decide to mine more, it resists more mining of it. So it's harder. Silver is easier to mine. So when the demand rises, then the producers can inflate the supply in this situation, it means mining more silver to meet the demand. So that would be easy money. Now, stock to flow captures the existing stock versus the new flow ratio. What does this mean? Stock is the current accumulated supply. So you could say all the gold in the world or in the country. Flow is the amount of new supply. So it's how much is being mined in this, in a situation of gold or silver. And you could say annually. So stock to flow is a ratio of the accumulated current over the amount of new, and you can say annualized per year. The
Yeah.
easy money trap transfers wealth from holders to producers. What does this mean? When you have soft money, let's say you have two countries and one is using soft money and the other one is using hard money. When they trade, the purchasing power gets sucked over from the soft money users into the hard money. So that's this hard money, easy money trap, hard money trap, and this transfer wealth.
Yeah. So this truth, it really solidifies that hardness is about supply response, not rarity. A monetary good is hard when the new supply cannot easily increase in response to demand. The measure is stock to flow ratio, how much exists divided by how much is produced per year. So gold has high stock to flow because almost all gold ever mined still exists. And annual production is a tiny fraction of that stock. So if demand doubles, miners can't double supply quickly. Fiat has low stock to flow because central banks can create unlimited new supply. Bitcoin has absolute hardness. There's 21 million coins. There's a known issuance curve, and there's no ability to surge regardless of the demand, right? You can't just arbitrarily create more Bitcoin. So the key insight is that hardness is not about rarity, but it's about whether holders can be diluted. Gold is rare, but miners can still find more. Bitcoin is hard because the protocol enforces the 21 million cap. This supply response to demand is exactly zero. So, um, for to implicate this, so every monetary system has a dilution surface. Who can increase supply, under what conditions, how quickly, and can holders see that surface and verify it?
All right. Here's our second diagram. We have hard money and we have easy money. With hard money, the demand rises, like we were saying, supply can't surge. And so people who are saving, their savings are preserved or their purchasing power is preserved. On easy money, you have the demand rising, the supply is inflated. So people that can do, we could say mining, you could say issuing, or what have you, the supply is inflated in order to match the demand. And then the people who try to hold the savers, they get diluted, like we're saying. Now, with Bitcoin, the demand, more mining security, you don't get any extra issuance. There isn't more Bitcoin, even though there's more mining or what have you, because there's a difficulty adjustment. Now, truth number three, sound money changes time preference. So, good store of value makes future planning rational. What do we mean? So, your time preference is going to be what you prefer as far as your savings. If you were to have a good form of money that makes it rational, and now you're capable of planning for the future, so you can save for things that would cost a lot in the future. If your money gets diluted, there's inflation, you're losing purchasing power, you want to get rid of it. You want to move it into something else that holds value. And so now, if you're using that type of money, it's irrational to try to save for the future using that money. Now, saving funds, capital accumulation, and longer production. What is that? We we explained it a little bit, but if you want to plan for the future, for instance, if you're an entrepreneur and you want to meet the demand that you expect for the things you're going to produce in the future and hire people now, then it's going to be more rational for you to save. Now, easy money distorts the prices and the opportunity costs. Opportunity costs being, how expensive is it? What am I going to lose if I don't save for that one opportunity in the future? If you have easy money, it gets diluted. The risk becomes greater sitting on it. Now, remember, fiat is decree by government, let's say. Fiat credit shifts allocation from savers to bureaucratic credit systems. So you have some kind of response to this dilemma where you're issuing credit as a money printer, let's say. But the problem is the people, the regular Joe who saves, they get destroyed. They get their money diluted, even though they're trying to be a good saver. But the people who are the monetary authorities, they increase their discretionary power. And you have the Cantillon effect, which is the people closest to the money printer get rewarded because they take this credit, this fiat credit, and they're able to purchase things before the inflation affects them. But everyone further down in the trickle down, they get hit by the inflation. They get hit by the loss in purchasing power.
The aftermath.
Yeah.
Mm-hmm. So, this third truth, it really emphasizes that money is not neutral. It shapes the time horizon of the society that uses it. Time preference is the discount on future versus present consumption. Would you rather have $1 today or $2 next year? Hard money lowers time preference. When savings hold value, you can afford to wait. You invest in long-term projects, build durable infrastructure, you can plan for generations. Hard money societies built cathedrals, canals, railroads. They could calculate returns over decades. Fiat money raises time preference. When savings lose value to inflation, waiting is very costly. You spend now, borrow now, speculate on assets that might outrun inflation. Fiat societies produce consumption, speculation, and short term thinking. The money itself shapes the time horizon. So, this is not simply a theory. If you're building systems that depend on long term commitment, such as staking, governance, or protocol development, you need to think about what monetary environment does to time preference. Soft money creates pressure to extract now, and hard money enables patience. So, the question when we're building is, does your system reward long term commitment, or is it just for short term extraction? We would rather the former.
All right. So our third diagram, future planning chain. So if you have a reliable store of value, so that you have these three ways of looking at money, the store of value, medium of exchange, and now I'm forgetting the third one. They what's the third one? Store of value, medium of exchange, and unit of account. We talked about that.
Mhm.
So if
Mhm.
you have a reliable store of value, you can have more saving. It's more rational to save. You have capital accumulation, like we were saying earlier, and then you have longer production structures, like we were saying. Oh, we want to have a canal in the future. It may take 10 years to build. Higher productivity and resilience. So this is some of the benefits of having a hard money versus a fiat or soft. Truth number 4, Bitcoin's inefficiency is the point. A centralized ledger is faster if you trust the operator, and that's if you trust the operator. Trust them not to debase. Bitcoin spends resources to remove that trusted operator. What are we saying there? There's a trade-off. If you if you trust the operator, you can be faster. If you can't trust the operator, you're going to have to, like we're saying, spend resources, proof of work, and you're going to be less efficient there. Everything that's centralized is more efficient. That's the trade-off, generally speaking. So proof of work makes fraud costly and verification cheap. And then the trade-off is sovereignty, so control of your money, and immutability. So you can't change this unit of account over throughput. So throughput being, if you want to have faster transactions, like say Visa, they're going to have higher throughput, but you're going to lose, saying this argument is the trade-off, is you're going to lose sovereignty, control of your money, and the immutability. So someone being able to reverse your transactions.
Mhm. So yeah, this fourth truth emphasizes that Bitcoin satisfies the monetary criteria with digital settlement. It again, we've referenced this before, but it has a fixed supply schedule. There's 21 million coins. There's a known issuance curve. There is no ability to surge the supply. There's peer-to-peer settlement, meaning that there is no trusted third party required to verify or complete transactions. Difficulty adjustment. Mining adjusts automatically to keep block time stable. Decentralized, and it has decentralized issuance, meaning that there is no central issuer and there's no discretionary authority to mint or to freeze. So Ammous argues this makes Bitcoin the first digital hard money. It's not hard because someone promises, it's hard because the protocol enforces it. It's not peer to peer because a company says so, it's peer to peer because the mechanism requires no intermediary. So the comparison with gold is very key here, and we're going to go back to that. Both are hard money, but gold settlement requires physical delivery or trusted vaults to hold them. Again, these are heavy, big. I mean, in proportion, they can take up a lot of space. Bitcoin settlement requires only the network. Gold is hard to verify without expertise. Bitcoin is verifiable by any node. Gold is heavy and slow to move. Bitcoin is weightless and fast to transmit. So the trade off is you give up stabilization in exchange for no discretionary authority. So there is no lender of last resort for Bitcoin. There is no central bank to print more during a crisis. Ammous argues that's the point. The stabilization lever is the capture lever. And if you want to remove capture, you must also remove the stabilization.
All right, trustlessness. So what is the trustlessness trade-off? What is trustlessness in general? You have trustlessness. If you have that, that means you're not relying on promises. You're relying on rules, enforceable rules, and verification. That's trustlessness. So on the left, you have trusted, on this diagram, you have a trusted ledger. So you're trusting a third party. And when you trust a third party, you're trusting them to be, you're trusting their behavior, you're trusting them to be honest, and you're also trusting their competency. And then on the right hand side, you have the Bitcoin ledger. So it's going to be the trustlessness or the permissionless. So on the left side, the trusted ledger, it's cheap, it's fast, it's reversible, which some people like. So you can reverse transactions. You can say, I didn't pay you, or this person didn't pay this person. And it's censorable. Again, some people like that. On the right hand side, the Bitcoin ledger, it's expensive, it's costly, it's slower, it's irreversible. So that's final settlement. And it's very hard to censor. So you want to use the expensive path where removing trust is worth it. This is the trade-offs. Now, when we're talking about policy, what do we mean? Removing, and what are the implications of reasoning about policy? Removing discretion from issuance. That discretionary power, I think, is something, when we're talking about this subject, you want to internalize. Central bank stabilization is also a choke point. With the stabilization, which is a benefit, they're controlling interest rates, controlling money supply, and the argument is that they're controlling inflation or deflation, and there's a benefit to that. You may go one step further and say that they're also controlling unemployment. Now, with Bitcoin, fixed issuance removes the monetary policy committee, so the choke point's gone. The people who say we're raising interest rates or not. Within Bitcoin, the nodes enforce the rules, and the miners cannot inflate against those rules. This is a common misconception. People really think that miners can do whatever they want, and it's not the case. The nodes are the ones that enforce. The policy within Bitcoin is the protocol. It's not the Fed press conference where they say we're going to increase interest rates and manage unemployment this way or that way. So now, what is the argument for Bitcoin as the anti-choke point? Base money. The base money is the settlement money. You settle, you're transferring from one to another, and it's very hard to reverse or impossible to reverse. Implied here is that you could make other types of money on top of the base money. Now, the first lemma, if coordination between nodes is not practical, then moving out of current rules is risky. What do we mean here? Coordination between nodes is not practical. It's actually hard to coordinate a bunch of people to change the rules in a way that would be significant. So then that means moving out the current rules is risky. If moving out the current set of rules implied here is Bitcoin, is risky, why is it risky? If you change the rules or you try to force a change, you can create a coin split. And if you're someone who mines and you're on the wrong chain, it's risky because all of your money could be worthless and you spent all that electricity on the wrong chain. So it's risky. then consensus rules remain hard to change. There's a penalty for doing these splits. Now, if the consensus rules remain hard to change, especially the money supply, so increasing the amount, then Bitcoin can function as hard money. And remember, hard money is resistant to inflation and uncensorable digital cash without a third party intervention. You don't need a trusted third party. Now, for our critiques of the book, with software craftsmanship, if you're trying to build something, and this book is about the Bitcoin standard, trying to build something, let's say, on top of Bitcoin, you're going to want to reason about it. If you're trying to do it in a decentralized way, you're going to want a language for monetary standards lifted from uh, this book or other communities that reason about the same about Bitcoin in the same way. You want to treat money, and again, this is a motif we're using in all of our reviews that we've lifted from the Structured Interpretation of Computer Program and some other books. We want to treat money like a language. You're going to have primitives, composition, and abstraction. These are three ways to critique a language. The primitives within this book are saleability, hardness, stock flow, issuance, settlement, and trust. These are, you could say, low level words, concepts that you can use to reason, obviously, about the money standard, but you can also compose them. So the fundamental methods of composition that we could lift from the languages within this book, network effects. Network effects are what makes for one thing it does within this concept, within this domain, is create it allows one of the forms of money to win. So gold, for instance, the network effects, saleability, and all this. Network effects plus supply rules plus verification create a standard. So you could say dollar standard, you could say gold standard, you could say Bitcoin standard. So combining the primitives, you could create a standard. Then you have abstraction, fundamental method of abstraction. Within this domain, you have, this is kind of the meta composition or the workhorse. So we talked about the hard money trap. Again, if you have two communities, let's say two nations, and one has soft money, one has hard money, the hard money will start to suck the purchasing power from the soft money nation. Fiat choke points, we talk about that, decree, and then the choke point is the monetary authority, where they can start issuing. You could succumb to the different effects that come from that, like the Cantillon effect. And then the trustlessness trade-off, we talked about that, where inefficiency is the point, but you gain trustlessness. So also, reasoning about monetary standards, the ubiquitous language that you could, in one concept within the monetary standard, and would be naming the monetary standard before debating the asset. What do we mean there? You could have a metallic monetary standard, that's gold. You could have the fiat monetary standard, Bitcoin. But people will, when you're debating about monetary standards, they could go back and forth between all these different types without knowing that they're incompatible, and you're debating properties without actually focusing on, you're talking past each other. So within the ubiquitous language, you're trying to stop that when you're building on top. Like, let's say if you're trying to build something like a Fedimint, which sits on top of Bitcoin.
Yeah. So what this book reveals, it's awesome. So money is not imposed from above. It's a market standard selected for saleability across time, space, and scale. Oh, let's see. The slide doesn't appear to be showing up here. There we go. All right. So, second, we know that hard money preserves value across generations. Fiat erodes it. Time preference isn't a personality trait, it's shaped by your monetary environment. And then Bitcoin offers something new: exit from the discretionary monetary authority. All right. It has a fixed supply, peer to peer settlement, and it has no issuer. The stabilizer is the choke point. Whoever can stabilize can also capture. Removing discretion removes capture surface, and trust assumptions must be visible by default. If you can't see who controls what, you're already captured. Okay. So when we are building, what should we keep in mind? So, when building a monetary protocol, we would want to avoid discretionary supply, and we'd want to adopt a fixed schedule and verify consensus. Now, I am going to give some examples here, and these are a lot of Web3 alternatives. These again, we're going back to there's blockchain technology, there's Bitcoin, and then there is everything else, right? So, an example of just what is out there of what we would want to avoid when building, at least for price compliance, which is no pre-mine, no roadmap, no issuer, and no censorship, is for a monetary protocol. Again, we wanted to avoid discretionary supply, right? So, a example of one that could be created at will would be USDT or USDC. Those have issuers who can freeze or mint new coins at any given time. And because they have the authority to do so, it would be Tether or Circle. So the second would be for a custody platform. We want to avoid opaque reserves and adopt verifiable reserves and verify those claims, right? So this would be the difference between taking self-custody of your Bitcoin versus leaving it on a centralized exchange in which you don't know if it is truly supported, if they actually have the um, the crypto that they claim that they have, right? So, and I want to relate this back to historical events because there have been a lot of centralized exchanges that have gone down in the past, and money has been lost, and it's very difficult to verify the reserves of how much they, if they have as much as they truly say that they do, because it's difficult to verify when everybody's assets are pooled together. So self-custody would be the response here. So next we have the settlement layer. We want to avoid centralized clearing and adopt peer-to-peer finality and verify reversibility, right? Again, they should not be reversible. So an example of a Web3 technology that currently has a um, a centralized authority that can reverse payments would be layer twos that sit on top of, say, Ethereum, right? And I'm just going to throw them out there like Polygon or Base. These are both layer two chains, similar to how Lightning is to Bitcoin. Polygon and Base are to Ethereum, right? If the Base settlement layer can be censored, if you can freeze or reverse transactions, then that means that your settlement layer can be, in essence, centralized. So for governance mechanisms, we want to avoid single authority and adopt rule-based governance. and verify exits. So rules based. For example, with Bitcoin, you complete the computation to mine a new block, and new Bitcoin is released. That's the rule. That's what it is. You cannot just arbitrarily mint new tokens. You can't create it. It's what it is. So for those, that just about wraps it up for me.
Right. Now, our third critique, builder usability. You want to make the monetary trade-offs easy to understand. And this is all about trying to, when we're building within any of these domains that we're critiquing, in this case, we're talking about Bitcoin, we want to make it to where the on-ramps are as easy as possible. So we want to make the happy path show within this domain custody, issuance, settlement, and reversibility. Convention over configuration. We want sane defaults. So default trust maps and supply schedules, monetary supply schedules. Again, if you're building on top of Bitcoin, an example would be something like that. Omakase. So this means, you're letting the chef choose for you. You want to have an opinionated monetary standard dashboard, for example, where people are able to reason about this framework or community you're building in a way that would be along the lines of the strong opinions of, let's say, the book, where you're wanting a Bitcoin standard. And then you want an integrated system first. So putting all together, wallet node reserves, and how you would audit these things, you'd put all of these together and make it to where people can start from something that is end-to-end working, and then after that make it to where people can piecemeal their solutions. So questions to contemplate: what exactly are users trusting in your system if you're building on top of Bitcoin? Can supply change, the monetary supply again, and who can change it? Is there an issuer? When is settlement final and who can reverse it? Kind of defeats the purpose if we can reverse the settlement. And which trade-off are you choosing? Trust, throughput, reversibility, or sovereignty? And the conclusion: the book's core claim is monetary, not merely technical. Hard money means supply cannot easily answer demand. Bitcoin turns issuance and settlement into verifiable rules. And a design question is, what must users trust?
All right. And now for our practical moves, right? Ammous gave us a theory of monetary standards. The builder translation is to make monetary trade-offs legible. So here is the one model, one story, and one action for this episode. The one model is money is a market standard selected for saleability. It's hard money wins when new supply cannot surge. Time preference is shaped by monetary environment. Bitcoin is hard money implemented as sovereign code, fixed issuance, peer-to-peer settlement with no issuer. The one story is the history of monetary media, right? There are cattle, there are seashells, salt, gold, fiat. Each medium won for a reason. The winners had higher saleability and higher hardness than competitors. Fiat won by force, not by market selection. Bitcoin is the first digital medium to win by market selection with hardness matching gold. The question is whether digital settlement can match or exceed physical settlement in trustlessness. So the one action is to run a monetary standard diagnostic on your own systems. Ask yourself, what must users trust? Can they verify issuance, settlement, and rule changes? And can they exit without asking permission? So, for the sovereign curious, you would look for a place in your financial life where you're holding a claim that can be diluted, frozen, or reversed. Ask what would it take to hold a claim that cannot? Not necessarily Bitcoin, but understand the trade-offs of what you're making. For system builders, you would want to make monetary trade-offs visible by default. Every wallet, exchange, payment app, or token system should expose who can change supply, who can freeze funds, who can reverse settlement, and what users can verify themselves. Convention over configuration is show the trust assumptions, supply schedule, and settlement finality in the first screen.
All right. If you have comments, leave them in the comment section and visit bitlemmas.com for past episodes and other information. We'll see you next time.
All right. See you.